Inflation doesn't just raise prices, it rewires what a salary means. And right now, in 2026 Australia, that rewiring is happening fast. A $70,000 salary, something that felt genuinely solid just a decade ago, now puts you below the median full-time adult wage nationally. A $120,000 income, once considered the marker of real financial comfort, is increasingly stretched in Sydney and Melbourne. And even at $180,000 plus, the Australian tax office is taking nearly half before you bought a single grocery. So the real question isn't what you earn, it's what you do with what you earn. Because at every income tier, the strategies that work are fundamentally different, and most Australians at every level are leaving serious money on the table, not because they're careless, but because nobody ever laid it out clearly for them. Today, that changes. 3 income tiers, 3 completely different financial playbooks. Let's get into it. First, let's put these numbers in context. According to the latest Australian Bureau of Statistics data, the median employee earns around $1,425 a week. That's roughly $74,000 a year. Full-time adult average weekly earnings crossed $2,000 for the first time in mid-2025. So $70,000 today sits right around the national median. Not comfortable, not struggling, but right at that edge where every dollar of strategy matters enormously. And yet, cost of living has punched a hole through what that median actually delivers. Rents across capital cities are still elevated, grocery bills are higher than they were 3 years ago, energy costs haven't come down the way anyone hoped. So regardless of which tier you're in today, the game has changed, and your strategy needs to change with it. Let's start at Tier 1, $70,000 a year. After tax, including the 2% Medicare levy, a $70,000 salary leaves you with roughly $54,000 to $55,000 in take-home pay annually. That's around $4,500 a month, or just over $1,000 a week, to cover rent, food, transport, insurance, and everything else life throws at you. At this income level, there are 5 priorities that should drive every financial decision. Priority 1. Destroy high-interest debt. Full stop. Credit cards in Australia routinely charge interest rates between 18 and 22%. Buy now, pay later products, Afterpay, Zip, Klarna, all Australian-born or deeply embedded in our market, carry their own traps through late fees and spending psychology. The RBA has flagged rising balances accruing interest on personal credit cards. If you're carrying revolving credit card debt at 20% interest, no investment in the world reliably beats that return. Paying it off is the investment. Every extra dollar you throw at high-interest debt earns you a guaranteed, tax-free return equal to whatever that interest rate is. Nothing on the ASX can promise you that. Priority 2. Understand your superannuation guarantee and go further. Your employer is now legally required to contribute 12% of your ordinary time earnings into your super fund. At $70,000, that's $8,400 a year going in without you lifting a finger. But here's something many lower income earners don't know. If your income is below roughly $58,445, the federal government will match up to 50 cents in the dollar on personal after-tax super contributions you make yourself, up to a maximum $500 government co-contribution. That's free money, genuinely free. It takes one voluntary contribution and a tax return to unlock it. Priority 3. Build 1 month of expenses as an emergency fund before you invest in anything else. 1 month. Park it in a high-interest savings account. There are online banks offering genuinely competitive rates on savings accounts right now. This is your financial airbag. Without it, one unexpected car repair or medical bill becomes credit card debt at 20%. With it, life's curveballs stay manageable. Priority 4. Start building the investing habit now, even if the amounts feel small. Australia doesn't have a Roth IRA the way Americans do, We can't put after-tax money into a special account that grows tax-free forever. But what we do have are low-cost index ETFs available through micro-investing platforms like Raise or Perler, which let you invest with very small amounts and build real exposure to global and Australian markets. The habit matters more than the amount at this stage. Someone who starts investing $100 a month at $70,000 and keeps going is worth vastly more at retirement than someone who waits until they're earning enough. Compounding needs time above all else. Priority 5. Calculate your real hourly rate and decide what to do with it. Take your annual salary, divide by 52 weeks, divide by your actual hours worked per week, not 38. Be honest. That number is your hourly rate. Now ask, is a side hustle worth your time at that rate? Maybe it is in the short term, but equally ask whether a single professional certification or upskilling course could permanently raise that hourly rate forever. Often, investing in yourself beats investing in a hustle that tops out. At $70,000, the name of the game is eliminate the bleeding, capture the free stuff, build the habits. You are laying foundations. The house gets built later. Now let's move to Tier 2, $120,000 a year. This is where things get genuinely interesting because $120,000 sounds like a lot, and it was 10 or 15 years ago. But ABS data shows full-time adult median earnings have crossed $110,000 nationally. $120,000 in Sydney or Melbourne in 2026 goes further than it used to, but not as far as the number implies, especially once you factor in that at this income level, you're firmly in the 32.5%, now the 30% marginal bracket on earnings between $45,000 and $135,000. After tax and Medicare, $120,000 leaves you with approximately $87,000 to $88,000 in annual take-home. That's around $7,300 a month. This is the tier where wealth is either built or quietly hemorrhaged, and the difference comes down to one word: automation. Move 1. Automate everything. Reverse budgeting is the system that works here. The moment your pay hits your account, money moves automatically before you can spend it. Set up an auto transfer on payday, a set amount to a dedicated savings account, a set amount to your investment account. You live on what's left.
This sounds simple because it is simple, but most people do the opposite. They spend, then try to save what remains. That's a wealth trap. Reverse the flow. If you have a mortgage, the most powerful version of this in Australia is an offset account. Every dollar sitting in your offset reduces the interest calculated on your home loan, giving you an effective return equal to your mortgage interest rate, completely tax-free because it's not investment income. There's no Australian equivalent to the American HSA, but an offset account is arguably better. It compounds silently, it's accessible, and the ATO doesn't touch it. If you're not a homeowner yet, the next best option at this income tier is salary sacrifice into superannuation. You can contribute up to $30,000 per year in concessional contributions. That includes your employer's 12% SG. So if your employer is putting in $14,400 on a $120,000 salary, you have around $15,600 of room to salary sacrifice on top. Money that goes in via salary sacrifice is taxed at just 15% inside the fund instead of your marginal rate of 30%. That's a 15% tax saving on every dollar you redirect before it's even invested. Move 2. Calculate your FIRE number. Financial independence means having 25 times your annual expenses invested and generating returns. The 4% rule, a globally accepted framework for sustainable withdrawal rates, suggests that once your portfolio reaches 25 times your spending, it can theoretically sustain withdrawals indefinitely. At $120,000 income, work out what you actually spend each year, then multiply by 25. That's your number.
Now go to a compound interest calculator and plug in your current savings rate. The math will show you something powerful. Your savings rate matters far more than your income. Someone saving 40% of their take-home gets to financial independence in roughly 22 years from zero. Someone saving 10%? Over 40 years. Same income, vastly different outcomes. Drop your FIRE number in the comments below. Let's make this real. Move 3. Protect what you're building. At $120,000, if you're sick for 6 months, your financial plan collapses without income protection insurance. It's not glamorous, it's not exciting, but it belongs in the budget. Review it. At $120,000, the mission is automate the machine, maximize the tax efficiency inside Super, understand your number, and stay the course. And now, Tier 3, $180,000 and above. At this income level, the single biggest financial challenge changes completely. It's no longer cash flow. It's not access to capital. The number one threat to your wealth at $180,000 plus is tax. Australia's top marginal rate sits at 45% on income above $190,000, plus the 2% Medicare levy. Even at $180,000, before you hit the very top bracket, you're paying 37 cents in the dollar on earnings between $135,000 and $190,000. The government is your biggest business partner, and they didn't sign a contract. So the playbook at this tier is built around 4 key moves, each one designed to legally and strategically reduce that tax exposure while building lasting wealth. Move 1. Maximize concessional super contributions. The cap is $30,000 per year, and at $180,000, you almost certainly have room to salary sacrifice significantly above what your employer puts in. Every dollar of salary sacrifice that goes into Super at 15% instead of 37% saves you 22 cents per dollar before investment returns. And here's the part most people miss. If your total superannuation balance is below $500,000 and you haven't used your full concessional cap in prior years, you can carry forward up to 5 years of unused cap into a single year. That's potentially tens of thousands of dollars in catch-up contributions, all taxed at just 15% instead of your marginal rate. Move 2. Know your Division 293 exposure. If your income plus your concessional super contributions exceed $250,000, the ATO imposes an additional 15% tax on those contributions, bringing your effective super contribution tax to 30%. This doesn't make salary sacrifice pointless. 30% inside Super is still better than 45% plus Medicare outside it, but it changes the math, and it changes how aggressively you should prioritize Super versus other structures. Know your number. Move 3. Build wealth outside Super. Super's preservation rules mean you generally can't touch it before age 60. At $180,000, you should be building a parallel investment portfolio outside the Super system. Australian and global ETFs, ideally held in a structure that's tax efficient. Australian shares carry franking credits, essentially prepaid company tax attached to dividends, which reduce your personal tax bill. For someone in the highest brackets, these credits partially offset the income tax drag on dividend income. Understand them, use them, and be cautious about over-concentrating in employer shares. If your company offers an employee share scheme, understand the taxing point, the discount treatment, and have a diversification plan ready. Move 4. Investigate a family trust structure, if it suits your situation. This is genuinely Australian, and it's one of the most powerful income splitting and tax minimization tools available to high earners with a spouse or adult children on lower incomes. Income distributed through a discretionary family trust can be allocated to family members with lower marginal rates, dramatically reducing the household tax bill. This isn't a gray area, it's mainstream, ATO-acknowledged financial planning. But it needs professional advice to set up correctly. The cost of that advice typically pays for itself in year one. At $180,000 plus, the strategy is tax efficiency above everything else. Super, franking credits, trust structures, and diversification. Every decision runs through the tax lens first. So, let's bring it home. 3 tiers, 3 completely different games. At $70,000, eliminate debt, capture the free stuff, start the habit. Foundations. At $120,000, automate the machine, maximize super contributions, know your fire number. Systems. At $180,000 plus, tax efficiency is the sport. Super maximization, Division 293 awareness, outside super diversification, trust structures, architecture. The most important insight across all 3? The gap between what people at each income level could do and what they actually do is enormous. Not because of intelligence, not because of access, because most people never had a clear map. Now you do. If this breakdown helped you see your own situation differently, subscribe and check out the companion video on how to actually build an ETF portfolio in Australia, step by step from your first dollar to a diversified portfolio. See you there.